November 2016, question 3B. November 2016, question 3B. So the question says that the Boa Limited manufactures a range of products. The company absorbs production overheads using a rate of 200% of the direct wages. The rate was calculated from the following budgeted figures: the variable production cost, the fixed production cost, direct labor cost. The management is faced with the following decision-making problems. Problem 1. The normal selling price per unit of product XM is shillings 220, while the unit production cost is as follows. We have the raw materials, the direct labor, production overheads. There is a possibility of supplying a special order for 2,000 units of product XM at shillings 160 each. If the order is accepted, the normal budgeted sales would not be affected, and the company has the necessary capacity to produce the additional units. The problem 2, the cost of making component B, which forms part of product Y, is given below. We have the raw materials, direct labor, production overheads. Component B could be brought or could be bought from an outsider for 200 shillings. Fixed production costs will not be affected. Now advise the management on whether to accept the special order under problem 1. And evaluate whether the company should continue to make component B or buy it from an outside supplier under problem 2. Now, the very first thing is to get to compute the overheads absorption rates. The overheads absorption rates. Now, first of all, if we start with the variable, you will take the 6,400 that is given up there, you divide by the direct labor. The direct labor is 8,000. You multiply by 100. Multiply by 100. So compute that and give me the answer. It is 80%. Then for the fixed, we have 9,600. You divide by 8,000 times 100. %120%. Then the total, it is this 6,400 plus this 9,600. You divide by 8,000 times 100. Times 100. That is 200%. That's how they have arrived at the 200%. So when we look at problem one, it is a case of special pricing decision. Special pricing decision. Special pricing decision. Special pricing decision. So these were the OERs. Now we come to this one. As you know, when we are dealing with special pricing, we always work with the variable components. So the first one is raw materials. Raw materials. Now, raw materials, we have 80. We have direct labor. Direct labor is 40. So that gives us the prime cost, an amount of 120. The prime cost is an amount of 120. $120. By the way, is my screen still visible as usual? Ama there is any change you can notice?
Yes.
It is okay, as usual.
Okay.
Okay, thank you. Yeah. Then from there now, you bring the variable overheads. Variable production overheads. So the variable production overheads, it is 80% of labor. Labor is 40. Labor is 40. So when you get 80% of 40, it gives us an amount of what? That 2. So the relevant costs, is 152. That is the marginal cost. Now, this marginal cost, you are supposed to compare it with the special price. Special price, the special price that they are quoting. So they are quoting a special price of 160. They are quoting a special price of 160. So when you compare those two, you now need to make an advice. Do we accept the offer or we should reject it? Tell me. Do we accept that offer or we should reject it? Yeah, we should accept it. We should accept the offer since special price is greater than marginal costs, marginal or relevant costs. Yeah, so this one is greater than 152. So we should accept that offer. So we proceed on to consider the next problem 2. Now problem 2 is make or buy. Problem 2 is make or buy decision. This is a make or buy decision. So we again do the same. We have raw materials. Raw materials is 40. We have direct labor. Direct labor is 80. So that will give us the prime cost. A prime cost of 120. 120. Prime cost. Then variable production overheads. Variable production overheads. So variable production overheads, we take 80. 80% of these 80. $64. So the relevant making costs. Relevant making costs. Relevant making costs is 184. The relevant making costs is 184. So the external, you simply now compare with the external purchase costs. The external purchase cost. The external purchase cost, these guys are saying they will buy or they will sell to us at 200. So when you compare those two, what advice do you give? Should we make or we should buy from them? Should we make by ourselves or we should buy from these fellows? Yeah, we need to make the product, since it will be cheaper than to buy. It will be cheaper than to buy. It will be cheaper than to buy. So that is how we handle such kind of question. These decisions are not very many in the management level, management accounting at this level. They are more at the advanced level. So we may not get a lot. But let me see whether I could get another one. You can take this one. You shall look at it later on your own. May 2014, question 1B. May 2014, question 1B. You can look at it. Priska, how are you?
I'm good.
Priska, how are you?
I'm good.
Karibu sana.
Thank you.
So that is what you have done so far. You can screenshot before I rub. So I'm not able to get a question on make or buy, but having done the other decisions, You are now familiar with it, or you should be familiar by knowing that we simply compare the variable costs with the external purchase cost. Yeah. So I think that will be fine. We can cross over now to the next area. Tumesoma, that was non-routine decisions. So the next area is budgeting. Is that so? Is budgeting. And I've already given you the notes on budgeting. And budgeting is one of the easiest areas in management accounting. And when we talk about a budget, it is a financial plan that shows the expected incomes and the expected expenses. It can also be used to show units, or we can budget for units. Now, budgets are important because they help us to plan, they help us to control costs, they help us in communication. We are able to communicate what is in our mind. They are very, very effective when it comes to coordination of the various efforts in an organization. They are also a source of motivation. We are able to motivate ourselves. Annette, good evening. Karibu sana. So on the other side, the disadvantages are a budget is based on estimates, which may not always be accurate. That is a weakness. You may also find that a budget is faced with a lot of future uncertainties because we are budgeting for something into the future. We are not very sure. When we use budgets, it also encourages us to be rigid, whereby you'll find people saying that if this was not put in the budget, we have nothing to do with it. The other thing is it can make people to spend up to the allocated amount just for the purposes of spending so that they don't lose the benefits next time. It can also create what we call conflicts among people when resources are being shared. You normally see this even in parliament. When they are making the national budget, you'll find that the MPs are quarreling. Yeah, so they bring a lot of quarrels and so on. Now, in making of a budget, we have a group of people who are tasked with that responsibility, and we normally call them budget making committee. So the budget making committee essentially sits down, considers all the requirements from various departments or various users, and then they also consider the various resources that we are likely to have, and then they arrange them so that they're able to say, this is the much money we have, this is the much expenses we have, itapangwa namna hii. So that is the role of the budget committee by and large. And then after they prepare the budget, they need to oversee the implementation. They need to keep on checking, are these guys implementing the budget as we said? Then they compute variances. Actually, after the topic of budgets, we will be discussing variances. Now, they also come up with a document that explains about the budget, and that document is called the manual. And the manual gives us details of the budget. Just a minute. Okay, so we are talking of the manual, very, very important. Then the approaches of making a budget, we have what we call the top-bottom budget. Top-bottom budget is a budget which is made by the seniors huko juu. Inaletewa watu tu, mnaambiwa tumeamua hii na hii na hii. That's called top-bottom. Then the opposite is called bottom-up. Now, bottom-up is a budget that is made by people down here. They give their expectations, and then those expectations are captured in the budget, and they are taken to the seniors huko for approvals and for formalization. And then the company has a budget. The components of a budget, or the various types of budgets that you come across, first of all, we have what we call the functional budgets. The functional budgets, we have Kina cash budget, we have the sales budget, the production budget, the material purchase budget, labor budget. Actually, everything that you find in the income statement can have a budget and has a budget or should have a budget. So we are going to draw those budgets. You see them. And as I've said, they are one of the easiest things in management accounting. So the steps that we follow in a budgeting process is you come up with assumptions. Assumptions means you assume we are going to make this money, we are going to spend like this. Then you take note of the available funding. Then you allocate the costs. Then you come up with the budget. Then you obtain the revenue forecasts. From there, you ascertain the budget for departments. You validate the compensation. Then there is the bonus plan. And then you obtain the capital budget requests, and then you have the budget installed, and then it runs. I think from the notes that I've given you, they have a lot of literature. You can go through them. They have a lot of literature. You can go through them, and they will help you. But for the computations, let's get to the past papers. Let's get to the past papers and draw the budgets. Haya, So let us go to this one of December 2023. December 2023, question number 4B. Let's get there. December 2023, question 4B. Inasoma Motomoto Limited operates standard costing system. The following budgeted information relates to its only product: direct materials, direct labor, direct or fixed overheads, standard cost per unit, and then so budgeted production amounted to 800,000 at 800 units at a unit price of 1,300. Actual production, we are given that additional information. Budget fixed overhead for its product is based on budgeted output. Standard selling price, there was no, okay. Then you're told to come up with the flexible budget. Now, in this kind of a question, we draw something we call budgetary control statement. Budgetary control statement. Budgetary control statement. Now, budgetary control statement inakuanga na details here. Inakuanga na details here. Then inakuwa na original budget. Original budget is also called the fixed budget. The fixed budget. Then inakuwa na actual results. actual results, alafu sasa inakuwa na flexible budget. Flexible budget huwa tunaipea a little bit bigger space. That way. So when they ask you to draw the flexible budget, that is what they are talking about. The original budget, actual results, flexible budget. Now, the first thing is to bring units. Now, units of the original budget, we are told they were 800. And the units of the actual, we are told they were 850. Now, the units of the flexible are the units of the actual. So you bring them here. So here, unaweza ifungia on its own. Unaweza ifungia on its own. The next thing we do is to compute percentage. And percentage, this is what you do. This one, you assign it 100%. Then you ask yourself and answer. If 800 is 100%, 850 is what percent? 850 is what percent? Work that out and tell me 800 is what percent? Are you sure? If 800 is 100%, you are supposed to say 800 is 100. So 850 is what? It is 850 times 100. You divide by 800. So is that the one giving us 106.25? Someone else to confirm that. Is it confirmed? Okay, so if it's confirmed, that's okay. Higher. The next thing now is to bring the revenue. Sales revenue. So sales revenue, you take, have they given us a selling price? At the unit price, yes, information 2 inasema budget selling price was 1600. So utachukua this 800 times 1600, uniambie hiyo revenue ni ngapi? Niambie hiyo revenue ni ngapi? $1,600 times 800. $1,280,000. Then we let's the material costs. Material costs. So material costs, we have material A. Now material A, you can see we have 420. So chukua hiyo 420 that you can see there, you multiply by 800. The 420 multiplied by 800. $420 multiplied by 800. $336,000. Then for material B, you do the same. It is 500 times 800. 500 times 800. 500 times 800. 400,000. Higher. Direct labor costs. Labor cost, you can see it is 110. So utachukua 110 times 800. $88,000. Then we have the fixed costs. The fixed cost is 270. times 800. Huh? Is not 880. One ten times sio ndio labor 110. The others, Prisk and it is 88,000. Okay, so if it is 88,000, that's okay. 88,000. Oh, okay. 88,000. Thank you. Now give me this one. 270 times 800. To 16,000. So all those costs now, we subtract them. And we get the net profit. The net profit. So subtract those costs from the revenue. We get a profit of 240. Now for the actual inakuanga rahisi is just copying the figures as they are given. Revenue is 1,326,000. This is 325, 350. This is 270,000. This is 97,900. And this is 229,500. And the profit is 403,250. The only thing you can do is to confirm whether that profit is okay. So if it's okay, that's good. Now, to prepare the flexible budget, as I told you, the units of the actual are the units of the flexible, and therefore the percentage is also the same. And therefore the percentage is also the same. So what we do, to flex means to change. We will change the original budget. This original, some people call it fixed. Some people also call it fixed or static. We want to change it to the new percentage. And the only thing that does not change is the fixed. Everything else changes. So utachukua hii revenue, this one, 1280,000. You multiply by the new percent, 1.0625. That is what you shall do. You can show the workings there, or you can put the mails where you just bring the answer. Nimesema what you do, we are looking to change the original budget to look like the new level. The new level. So the only thing that does not change is the fixed cost. All these others, the revenue and the variables, we multiply them by the new percentage, this one. So you take this revenue multiplied by 1.0625. Is that okay, Eric? Good. So I can see the answer is 1360,000. We come and do the same with material A. You take 336,000 times 1.0625. Times 1.0625. $357,000. Then 400,000. 400,000 times 1.0625. $425. Then this 88,000 times 1.0625. $93,500. So this one remains 216,000. So with that now, get the new profit hapa. Subtract these costs from here. $268,500. Yeah, 268,500. That is how you make a flexible budget. Let's go to this one that was examined in April 2022. April 2022. April 2022. Question number 5A. It is also on budgetary control statements. Where we do have the details here. I think let me divide it into 3 sections in case there will be, although the one for the actual really has workings. So hii ndio naweza fanya ikuwe kubwa. Original budget. Hii ni dogo, actual budget or actual results. Actual results. And then flexible budget. Yeah. Let us have the workings even for the original budget there. So if you are there, the question inasoma, Smart Products Limited operated standard costing and budgetary control system. The following is the company's standard cost card: direct materials, direct labor, variable overheads, fixed overheads, standard cost per unit, standard profit per unit, standard selling price per unit. Each unit required 3 kilos of material, which cost 40 per kg and 45 minutes of direct labor at 80 per hour. Variable overheads are recovered on direct labor hour basis. Fixed overheads are absorbed on an annual production budget of 180,000 units. For the year to that 1st of March 2022, 120,000 units had been manufactured and sold. Contrary to the management's expectations, the company's profit and loss statement reflected a loss of 1,380,000 instead of the expected profit of 3.6 as provided below. So that is what we got. Then get the budget profit and loss account for the year and the flexible budget. So as usual, we start with units. Units for the original budget. We are told it was to be 180,000 units according to information 3. So 180,000. Or we can have all our figures in thousands. We can have our figures in thousands. So here we just put 180. And then for the actual, you can see the actual was 120. 120 according to information 4. And I have told you the units of the actual are the units you take to the flexible. 120. 120. So hii tunaifungia hapa. Kisha ifunga, we get the percentage. The percentage I've told you the original is always assigned 100%. So if 180 is 100%, tell me 120 will be what percent? What percent is that? Yeah, 66.67%. So that is the one we shall also bring here. That way. So from there now, we bring the sales revenue. The sales revenue. So the sales revenue, we will take these 180 units. You multiply by the selling price. According to the data there, the standard card, the selling price is 250. So multiply. 45,000. Then we say less. The first item is direct materials. Direct materials. Direct materials, again, you take 180 times the cost that is given up there, the 120. Hiyo 120, that 120 ndio imeongelelewa information 1 as 3 kilos each at 40. So if you multiply that, itakupea to 120. $21,600. Hiyo ingine ni direct labor. Utachukua hiyo 180 times 60. One 80 times 60. $10,800. Next is variable overheads. Variable overheads. You also take 180 times 20. $3,600. Then fixed overheads. It is 180 times 30. $5,400. So that is all. So with that, we are able to get the net profit. We are able to get the net profit. Net profit. Yeah, 3,600. Now that 3,600 is the one they are saying kwa information 4. Hapo mwisho, instead of the expected profit of that 600, that is the expected. Now for the actual tulisema hiyo hainaga maneno mingi, you just copy 22,800, 12,000 here, then 3,900, 2,880. So this one also remained 5,400. Confirm whether it is 1380 loss. Confirm whether that is the case. Yeah, so if it's confirmed, that's great. Now, for the flexible, I've told you the only thing that you will not change is this one, 5,400. These others, ukianzia hapa unachukua 4,500. Una multiply now, because this one is less, una multiply na 0.6667. Then hii ingine 21,600. Multiply by 0.06667. Then 10,800 multiplied by 0.6667. Then that 600 multiplied by 0.6667. Yeah. Then utaniambia profit yenye utapata hapa chini. I can see 600.3. Someone else to confirm 600.3. Is it confirmed? Okay, good. So that is how you make a flexible budget. There is another format, and I think we came across it. Ile ilikuwa inatumia Hiro method. Ile umepewa two values, unatumia Hiro method. I think we solved a question like that. Sikumbuki ilikuwa aware of also making a flexible budget. But these ones that we have done are the most common. Most common types of flexible budgets. Nimeona hiyo moja, that other format. Naona time imeenda, we may not finish, but ni kitu tuna It's already 5 minutes tu. Oh, hii saa yangu. Okay. Wiki yangu iko sawa. Hebu fungua hii, umeiona wapi? This one of May 2019. Go to May 2019. May 2019, question 5. Is another way of making a flexible budget. Sijui kama ilikuwa kwa CVP. We came across a question of that nature. May 2019, question 5A. Is on flexible budget. If you are there, inasema Limu Processing Company manufactures a standard product branded LM. Currently, it's operating at a normal activity level of 70% with an output of 6,300 units. The sales director believes that a realistic forecast for the next budget period would be at an activity level of 50%. The following data relates to the forecasted costs of the product for different levels of activity. So we are given that. So you are told to get the flexible budget based on 50% level of activity. So the first thing that you do is to say, actually you may not need to convert them to percentages. Or rather, you may not need to convert them to units. You can either convert them to units or work with percentages. Either way can work. Either way can work. So what I want to do is you will say 70% is 6,300. So first of all, give me 60%. It is what? It will be 6,300 times 60. You divide by 70. $5,400 higher. If I want to know 80% will be what? It will again be 6,300 times 80. I divide by 70. If I want to know 80%. $7,200. And if I want to know 50% will be what? It will be 6,300 times 50 divided by 70. $4,500. So sasa hii unaitumia namna hii. Using high row method. Using high row method. Y is equals to A plus BX. Y is equals to A plus BX. We can start with direct materials. Direct materials. So for the direct materials, utachukua the highest. The highest ni 201,600. 201,600 is equals to A plus. The highest is this one. We are using the one at 80% and 60. So we are using this one and this one. Those are the ones that we are going to use, 80 and 60. So this will be 7,200 B. Then uchukue cost here at 60, 151,200 equals to A plus 5,400 B. So subtract. This minus this, let's be fast. Naona time imesonga. 5,400 equals this one, 7,200 minus 5,400. 1,800. So tell me B is what? $28. B is 28. So if you now come and say 201,600 is equals to A plus 7,200 times 28. Tell me the value of A. The value of A, 0. Let's be fast. Direct wages. We do the same. Direct wages. The highest cost is 86,400 being equal to A plus 7,200 B, and the cost is 64,800 is equals to A plus 5,400 B. You subtract, this one is obviously 1,800 B. Give me this done. 86,400 minus 64. $21,600. So from there, tell me the value of B. $12. So kuja useme 86,400 is equals to A plus 7,200 times 12. So tell me the value of A. Zero. So if it is 0, let us go to the next one. The next one is production overheads. Production overheads. Production overheads, the highest cost is 179,200 being equal to A plus 7,200 B, and 150,400 is equals to A plus 5,400 B. You minus, so niambie ya kwanza, it is 28. $28,800 is equals to 1,800 B, and therefore look for B. 16. Haya, so 179,200 is equals to A plus 7,200 times 16. So the value of A is 64,000. We go to the next cost, administration overheads. Administration overheads. The highest amount is 126,000. A plus 7,200 B. And the lowest is also 126,000. 5,400 B. So this is 0 being equal to 1,800 B. And therefore B is 0. B is 0. So if B is 0, then we come here and say 126,000 is equals to A plus 7,200 times 0. And therefore A must be 126,000. 126,000. Next is selling overheads. Selling overheads. So the selling overheads, the highest is 183,600. A plus 7,200 B. And then we have 169,200 being equal to A plus 1,800 B. This one is 1,800 B. Give me the difference here. The difference. $14,400. So tell me the value of B. The value of B is 8. So now 183,600 is A plus 7,200 times 8. Tell me how much is fixed. $126,000. So the flexible budget. So the flexible budget at 50%. In other words, these are 4,500 units. 4,500 units. So the first item is direct materials. Direct materials utachukua actually you can use the equation. You can use this equation. For direct materials, it will be 0 plus 28 times, ama nikuwekee ikiwa variable, lakini ni sawa. This one we already have separated. So times 4,500. Then ukuje kwa direct labor. No, direct wages. So hii sasa itakuwa 28 times 4,500. 126,000. Hiyo ndio utaweka hapo. Direct wages utachukua 0 plus 12 times 4,500. So 12 times 4,500 is 54,000. Production overheads. Production overheads. A is 64,000. And B is 16. So 16 times 4,500. So utasema 64,000 plus 16 times 4,500 is 136,000. Administration overheads. Administration overheads will be 126,000 plus 0 times 4,500. This is 126,000. 126,000. Tunaendelea tu. The next one is selling and distribution overheads. Selling and distribution overheads. Itakuwa 126,000 plus 8 times 4,500. 126,000 plus 8 times 4,500 is 162,000. So with that, now we get the total costs. So add all those costs, uniambie toto yake. Add all those costs, uniambie toto yake. Toto yake ni 604,000. So now they were saying that the profit is 20% of selling price. So profit, if it is 20% of selling price, that is what we call margin. And I told you margin is profit out of selling price. So if you are working with the costs, you must convert it to markup. And you simply less. You simply less. So when you less the numerator, it goes to markup. So you multiply by 6 or 4,000. You are getting what? $151,000. So with that, we get the sales revenue. The sales revenue that is expected to come from that tuition. They should make 7. Yeah, that's the match they should make. So thank you very much. Now, those are the 3 versions, the 2 versions of the flexible budget. So ukiona flexible budget anywhere now, you should comfortably handle. So we will do others in our next lesson. Thank you very much.